Hey guys, welcome back to another video. Today we're going to be talking about corporate restructuring and the available options that companies, public companies in the North American space have and the related wealth effects for shareholders. Now I'm going to be working off the Mergers and Acquisitions Corporate Restructuring 4th edition by Peter A. Gall, and this is more of a MBA book than an undergraduate textbook. There are quite some advanced chapters, but I really simplified the presentation to really get across the core options available to companies and some simple analysis of those options. So it's a great little introductory kind of presentation to the different corporate restructuring opportunities available for companies. So as always, if you do enjoy the video, please like and subscribe to the channel for more. And as well, if you want to purchase the textbook, I do recommend that you check out the video description. So let's get started. So companies often have to contract and downsize their operations. Now, this need may arise because a division of the company is performing poorly or simply because it no longer fits into the firm's plans. While many sell-offs are motivated by financial pressures brought about by high leverage and weak economic demand, the volume of sell-offs increases when overall deal volume increases. It follows the ups and downs of the economy. So compared to bankruptcies, where bankruptcies increase during the recessionary period of the business cycle, sell-offs increase in number during the expansionary phase of the business cycle. And that just makes sense. The associated valuation for those respective subsidiaries increases in value, and therefore the company itself, the owner of that subsidiary, feels much more incentivized to really monetize that holding or restructure it in a way in which the shareholders can benefit from that. So a quick overview of the core options available. There's the divestiture, there's the equity carve-out, the spin-off, the split-ups or the Bustups, the master limited partnership, the MLP agreement, and there's tracking stocks. And so this video is going to cover all of these different terms and the related shareholder wealth effects. So, divestitures. Most sell-offs are simple divestitures. The most common form of a divestiture involves the sale of a division of the parent company to another firm. The process is a form of contraction for the selling company, but a means of expansion for the purchasing corporation. Many divestitures are the result of sell-offs of previous acquisitions. Researchers analyzed 271 large acquisitions completed between 1971 and 1982. A total of 43.9%, or about 119 of these acquisitions, were divested by 1982. The divested entities were held for an average of 7 years. They investigated the common motive. So what did they find? They found that the diversifying acquisitions are 4 times more likely to be divested than non-diversifying acquisitions. And so this is very, very common. A lot of corporations are seeking growth to really please short-term shareholder expectations. They're kind of forced to make this acquisition in order to kind of meet those expectations, but it just doesn't make sense. And what's really interesting is that diversifying acquisitions, so acquisitions that are not close or related to the core good or service of that business, are 4 times more likely to be divested in the future than non-diversifying acquisitions, which complement the existing goods and services of that business. So really the key takeaway from a divestiture perspective is that if you're advising a company, it's probably more beneficial to kind of stick to what you know. And this has been kind of indicated across many studies. M&A, although it has a bad reputation, it is relatively a good opportunity to really maximize the value of a firm, to really add to shareholder value. But the thing is, you can really ensure that success by sticking to what you know rather than trying to go out and diversify, right? Because with diversification, what happens is, you bring that company, you put it under the corporate umbrella, you force out that management because now they're not really the top of the organization. They're just part of a subsidiary. And so you alienate that company. And what really happens is majority of the time, that company begins to underperform, morale is impacted, and at the end of the day, value is not created. So here are the common reasons for voluntary divestitures. So the 3 common ones are the change of focus or corporate strategy, the most common. The second most common is the sale to finance an acquisition or a leveraged restructuring. And the third most common is the unit is unprofitable or was a mistake from a strategy perspective. Now, this is relatively interesting because when I initially thought about, what would make sense to be the primary reason for selling a subsidiary, usually the unit is unprofitable or it's a mistake. But really, majority of the time, the reason why a divestiture is pursued is because of a change in corporate strategy, whether a new CEO comes in and has a different vision for the company, or the existing CEO is responding to changing shareholder demands. And looking at the other reasons, you have antitrust, which essentially means if they want to complete another merger or acquisition, they need to divest some of their existing assets. A need for cash, simply to pay down debt or meet current cash needs. To defend against a takeover, which is a defensive divestiture. Or there was a good price, which is pretty funny that out of the 103 divestitures that were analyzed in this study, only 3 were really sold just because of the price, which you really, that should be your primary motive. You want to maximize that price in order to get the top shareholder value. Majority of the time, it's either a mistake or you're selling it to finance another bigger acquisition, or it's just a change in corporate strategy, right? And so this kind of once again supports that whole statement of some majority of the time M&A is a bad strategy to pursue, although I disagree with that as an investment banker. Now, some other reasons also include a poor fit of division, reverse synergy, poor performance, capital markets factors, cash flow factors, and abandoning the core business. And we're going to go and look at each of these reasons. So reverse synergy. One motive that is often ascribed to synergy, M&A is synergy. When synergy exists, the combined entity is worth more than the sum of the parts valued separately. In other words, 2 + 2 = 5. Now, reverse synergy means that the parts are worth more separately than they are within the parent company's corporate structure. In other words, 4 - 1 = 5. In such cases, an outside bidder might be able to pay more for a division than what the division is worth to the parent company. And this is very, very common with conglomerates. Conglomerates have many different subsidiaries, companies that really aren't kind of related to the core business or, the core revenue drivers. And really what happens is they're really discounted in the eyes of shareholders, right? And so reverse synergy is a realistic path when you talk about divestitures and just selling off assets. Now, poor performance. Companies may want to divest divisions simply because they are not sufficiently profitable. The division could fail to pay a rate of return that exceeds the parent company's hurdle rate, the minimum return threshold that a company will use to evaluate projects or the performance of parts of the overall company. Management may be reluctant to actually sell the unit, however. It is an admission to shareholders and other executives that they did a poor job managing it or made a mistake purchasing it. And as an advisor, it's important to really kind of help management realize that. At the end of the day, you really want to cut your losses. You want to take a haircut rather than really stick with the business and try to, prove to others that, oh no, it wasn't a mistake. At the end of the day, you got to, suck it up. You got to realize that, everyone makes mistakes. And you really got to recognize that if the division is not meeting the company's hurdle rate, you should probably be divesting it. Now, a divestiture may also take place because the post-divestiture firm, as well as the divested division, has greater access to capital markets individually. The combined corporate structure may be more difficult for investors to categorize. Divestitures may create companies in which shareholders would like to invest, but that do not exist in the marketplace. Such companies are sometimes referred to as pure plays. And so essentially, the benefit of divesting in certain cases is that, the parent company becomes more focused, and therefore the banks are more willing to, put that company in a respective segment of its loan portfolio. Rather than defining it as a conglomerate, it's a steel company, and therefore steel companies have greater access to debt financing simply because of their real assets, their asset base. Whereas the divested division, maybe it's a technology company, right? And so rather it should be focused and identified separately as a technology company rather than a technology steel company, right? And so by splitting up the two, there's much more clarity with regards to the identity of that company and therefore access to the capital markets. Cash flow factors. A sell-off produces the immediate benefit of an infusion of cash from the sale. The selling firm is selling a long-term asset, which generated a certain cash flow per period in exchange for a larger payment in the short run. Companies that are under financial duress are often forced to sell off valuable assets to enhance cash flows. In certain situations where a company is struggling financially, it is best to, sell off the non-core businesses to pay down debt. But in certain instances, when you have a strategic or financial buyer approaching that company and they're offering a certain price, which, being familiar with the business, that if you were to discount the net present value of future cash flows and it's lower than that offer price, then it's in your interest to really accept that. So there are certain cases where a firm just can't turn down such an offer, and therefore they would rather take that immediate larger payment than the smaller cash flow per period. Excuse me, let me get a little bit of water. Alrighty, so spin-offs. This is another option. Now, this is a strategy where the parent company chooses to split off a subsidiary into a separate legal entity with its own management team and board of directors. This isn't a sale, however. No funds are realized from the spin-off. Instead, the shares of the new entity are awarded to existing shareholders, so the ownership base is exactly the same as in the parent company. So consider, ABC Corp is the parent company and XYZ is a subsidiary. Now, if XYZ were to be spinned off, essentially the existing shareholders of ABC Corp would also own XYZ based on the number of shares that they own in the parent company. It's a pro rata basis, right? And so what happens is that, you're creating an extra focus on that respective subsidiary. At the end, you're dedicating its own management team, its own board of directors to, focusing on that company. Whereas with ABC Corp, it's probably just a subsidiary and management has to focus on the greater organization rather than just those operations. So it creates focus, and majority of the time, it creates a lot of value for shareholders who become owners in that business and benefit from future performance of those shares. Now, the use of corporate restructuring to defend against hostile takeovers is known as defensive spin-offs. So in certain cases, companies may choose to spin off divisions to make them less attractive to the bidder. So defensive spin-offs or other types of sell-offs constitute a drastic takeover defense. So we talked about takeover defenses in another video, which you can find on my channel. But one option is really if a buyer, a hostile bidder, is interested in acquiring a certain division within a bigger company. Well, the company, if they really wanted to avoid that bid, could spin off that respective division to its existing shareholders so that the potential bidder could not really buy that company without going for it directly and thus benefiting and maximizing shareholder value. So that's another way in which you can prevent the change of control of the parent company by simply divesting and pushing that assets that's in demand away from the parent company. Now, there are tax implications of spinoffs which are beneficial. One of the advantages a spinoff has over the other types of sell-offs is that the transaction may be structured so that it is tax-free. Among the tax code's requirements for a tax-free spinoff are both the parent company and the spun-off entity must be in business for at least 5 years before the restructuring, and the subsidiary must be at least 80% owned by the parent company. So essentially what this means is that with a spinoff, there's no transfer of funds. No one's acquiring that subsidiary. Rather, you're just legally separating that entity away from the parent company, and you're awarding the shares in that new entity to existing shareholders. So there's no capital gains that's triggered. It's just a transfer of, the assets to different entities, and the shareholders that ownership structure is changed when it's reported in their own accounts, right? So there's no real trigger in capital gains. Now, to do so, to really claim that, the company needs to be in business for at least 5 years, and at the same time, the subsidiary must be at least 80% owned by the parent company, okay? And before the spinoff, of course. Now, what about the allocation of debt obligations and bond liabilities? When a company decides to do a spinoff, a decision has to be made as to which of the spun-off businesses will assume specific liabilities. Sometimes the answer is obvious. Perhaps the debt was part of a specific business that was acquired. If so, it may be logical that the business maintain these obligations after the spinoff. But sometimes it can be much more difficult. And so this is a lot of debate, again, with the legal team. And, it's all dependent on how management wants to structure the business. They can't put all debt on the spinoff entity so that, the parent company benefits, because that would be unfair, right? So there needs to be a little bit of fairness in that. Now, what about the wealth effects of sell-offs? A major motivating factor for divestitures and spinoffs is the belief that reverse synergy may exist. The research in the field of selloffs, whether they are spinoffs or other form of asset sales such as equity carve-outs, presents a clear picture of clear benefits for shareholders. Research from the 1970s through the early 1990s presents a clear pattern of positive shareholder wealth effects from corporate sell-offs. However, in recent years, there is some evidence that the market is not responding as positively to large-scale breakup announcements as it once did. So really, there are clear benefits to shareholders when it comes to corporate restructuring and spinning off respective assets. However, that the size and the impact of that benefit is significantly less in the 2000s relative to the 70s, 80s, and 90s. But still, shareholders benefit from the restructuring of the organization. Because at the end of the day, really what's happening is you're providing more clarity on the valuation of individual assets. That's the core, and that's the reason why corporate restructuring exists. Now, a study by Miles and Rosenfeld in 1983 also revealed that the positive stock price reaction was accompanied by a negative price reaction by the parent company's bonds. Some analysts have interpreted this to be the result of the fact that the cash flow from the spun-off entity may no longer be relied on to meet the debt service payments. Another explanation is that all factors being constant, larger firms tend to receive higher bond ratings, and therefore when the parent company is spinning off that subsidiary, it's becoming smaller from an asset perspective, and therefore bondholders are reacting negatively to that. But that's an interesting relationship. So the equity price, the share price of the company, once it conducts a spinoff, whether it's a divestiture or a spinoff or equity carve-out, increases usually, whereas bonds, the price of those of the company's bonds decrease. Now, what about the longer-term wealth effects? Researchers examined 815 distributions of stock in spun-off firms from 1965 to 1988. The research presents a very favorable picture of the post-event performance of spin-offs. Both spin-offs and their parent companies showed positive abnormal returns over a period that ranged between 6 months before and 36 months after the stock distribution date. So 3 years after the spin-off, there was clear tangible benefits seen in the share price of the company. And that's incredibly important to realize. Now, maybe the response to that may be, oh, well, with the spin-offs, they occur near the top of the market. So maybe, the market is just, naturally over-optimistic and might respond in the longer term. But giving a 3-year timeline, that's still a clear benefit when it comes to value creation. And really, this was something that I learned once I was reading this chapter, is that majority of the time, even though it might be a little costly and it might result in lower debt ratings, the company benefits from a valuation perspective when it pursues a restructuring strategy. Now, JP Morgan has conducted a series of studies on spin-offs. The study shows that the stock price of parent companies rises and increases sharply when companies announce that they are spinning off a division. The larger the spin-off, the greater the effect is. And so here we have the average cumulative market-adjusted return. Where's my mouse? Here's my mouse. So on the announcement date of the spin-off, the stock responds positively. And over time, based on the size of that deal, the bigger the spin-off based on asset value, the larger the reaction. And it continues post 10, 20, 30, up till 90 trading days. It continues to increase. And so that is a clear sign. And if you believe in the efficient market hypothesis, then the market is efficient in really predicting the overall corporate strategy and result of different corporate strategies, because the stock price will reflect that information. And so if the stock responds to the spinoff in such a large and positive manner, then that means that the market is expecting significant benefits from such a spinoff, which is once again beneficial for corporate restructuring. Sorry, I just recorded like 4 hours of videos, so I'm pretty thirsty now. So when the market responds positively to this asset reallocation, it is expressing a belief that the firm will use this cash more efficiently than it was utilizing the asset that was sold. Moreover, the asset that was sold may have attracted a premium above market value, which should also cause the market to respond positively. And so that's very, very important. Now here, essentially months from a perspective of months rather than days, the cumulative market adjusted return continues to increase. So beyond the almost 8% threshold after 90 days, after 18 months, it's hitting almost 16%. That's, again, a very clear benefit. If you believe in the efficient market hypothesis, this is very good. So, in another study, researchers concluded that cross-industry spin-offs create value only when they result in an increase in corporate focus. They attribute the performance improvements to companies removing unrelated businesses and allowing managers to concentrate their efforts on core businesses and removing the distraction of non-core entities. And this makes perfect sense. Shareholders reward that focus, and that has been proven consistently post 1960s, where conglomerates were much more popular. Now, equity carve-outs. Equity carve-outs became a popular financing technique in the late 1980s, even though the market for public offerings was poor. Many firms looked to equity carve-outs as a means of reducing their exposure to riskier lines of business. When a parent company conducts an equity carve-out, it may sell 100% interest in the spun-off subsidiary, or it may choose to remain in the subsidiary's line of business by selling only a partial interest and keeping the remaining percentage of ownership. So in the case of ABC Corp being the parent company and XYZ being the subsidiary, in an equity carve-out, the subsidiary is still spin-off, so it becomes a separate legal entity with its own management and board of directors. But instead of spinning that off and giving the shares, the ownership shares, to existing shareholders, it's almost sold. So maybe the company sells 20 or 30 or 60% of the business, and so another third party owns 60% while the company maintains the remaining 40% of those shares in the new publicly listed subsidiary. Now, when looking at the equity carve-out transaction data, carve-outs tended not to remain public very long after the transaction. Only approximately 37% remained in their original form 3 years after the carve-out. Approximately 15% were required by the parent company, whereas 11% were sold to a third party. So essentially, with equity carve-outs, seeing that the company is now spun off and it's also owned by a third party, majority of the time, it's motivated to really deviate away from the ownership of its parent company or its third-party company and become independent. And so the data shows that beyond 3 years, majority of those companies do not exist in their original form. Either they were sold to another company or they really kind of reorganized once again to maximize shareholder value. Whatever it is, equity carve-outs are another step in the corporate restructuring world. Now, Allen and McCollin conducted a study of the financial characteristics of firms that undertook equity carve-outs. They analyzed 188 carve-outs between 1978 and 1993. They found that carve-out subsidiaries tended to have poor operating performance and higher leverage than their industry counterparts pre-carve-out. So the carve-out firms, the firms that were to be carve-out in the future, had a lower EBIT to interest margin. So the amount of EBIT to cover the interest expenses on their related debt. Oh my gosh, sorry about that. So they were much weaker in handling their long-term debt. At the same time, from a long-term debt to total assets perspective, they had significantly more debt than industry peers. Total debt to total assets was higher, and then EBIT to sales, the margin was significantly lower. So really, the businesses were run poorly. So the cost expense was higher. They had higher debt and then much more leverage. And so really, it makes sense. Once again, we talked about the reason why equity carve-outs exist is that the parent company usually wants to exit that business or reduce its risk exposure to that business, right? But maintain a little bit of an interest in the business for future benefit. Right? And so these are really the prime candidates. Prime candidates for equity carve-outs are riskier, more leveraged business that on their own could survive on their own because, they have their own management team and board of directors that can focus on the business to reduce maybe the risk rather than, operating under the corporate umbrella of the parent company. Now, let's compare the equity carve-outs versus the spin-offs. Now, the following are the key differences. From a fund's perspective, with the equity carve-out, cash is raised. The parent company is selling an interest in that business. They're not spinning it off like in the spin-off, where no cash is raised and rather shareholders receive those shares. Now, from the ownership of the entity, the parent company maintains some interest in the company, and maybe a third party owns the remaining interest in that company. Now, with the spinoff, the parent company gives up complete interest. They receive no funds, and the shareholders of the parent company own the new shares of the spin-off entity. For the shareholders, the new outside shareholders own the entity, so you have the third-party shareholders owning the entity, whereas existing shareholders are owning the new entity. And from a cost perspective, to pursue an equity carve-out, it is much more expensive. The legal fees, the listing fees is much more expensive than just a cheaper restructuring through a spin-off. So these are some of the key differences. Now, what about voluntary liquidations? These are the most extreme form of corporate restructuring. Corporate liquidations are more often associated with bankruptcy, and that will be a future video on my channel. The liquidation option becomes viable only when the firm's stock has been depressed for an extended time. The liquidation option becomes even more likely when the stock prices of other firms in the same industry are not also depressed. So in a scenario where that respective company with its underlying assets is performing very, very poorly, its share price is performing very poorly, majority of the time, especially back in the 1980s, a lot of corporate raiders would circle these companies and really put pressure on the board to just liquidate, rather than try to rearrange the business to really realize that value in the share price. They recognize that all the other competitors were being valued at a higher rate than the business, and it must have been something that shareholders have lost trust in that business. And so really the corporate raiders framed it in a way that, we've given up hope for you to realize this value, so just liquidate it and let's get the actual cash value back. Now, there's also tracking stocks. A tracking or targeted stock is an equity issue that represents an interest in the earnings of a division of a company. Sometimes, when a company acquires other firms, but the market prices of the combined entity sell at a discount, the company may try to boost the stock by allowing one or more divisions to trade separately as tracking stocks. So essentially what a tracking stock is, say for example, we have that big parent company, ABC Corp, and rather than spinning off or creating selling a bit of equity in XYZ, we create a tracking stock. We have our own stock for ABC, but we also have a stock for XYZ. Now, it's still owned by ABC, but the tracking stock tracks the performance of that respective XYZ division, right? And so if sales are increasing, if profits are increasing with respect to just the sole division, then the tracking stock also increases in value. And so when the company issues that stock and it raises those funds, what happens is they're monetizing and realizing that underlying value for that respective subsidiary. And these were very common back in the day. They're not as common anymore in the 2000s. Now, tracking stocks have also been used as a defense measure when a company is confronted with a large and somewhat hostile shareholder. Instead of a spinoff, the company could reason with a hostile bidder and issue a tracking stock for that subsidiary. One of the major differences between tracking stocks and selloffs is that a separate legal entity is created in a selloff. With a tracking stock, the shareholder has a legal interest in the earnings of a division, but the division remains part of the overall company, and that's the big distinction. Now, a recent example is the Dell Technologies tracking stock that you can find on the NYSE. So DVMT is the ticker symbol. Now, Dell was taken private a few years ago in a very, very big management buyout deal. And so in order to finance that deal, one of the things that they did is that VMware, which was a subsidiary of the greater Dell Corporation, was focused on through this tracking stock. And so the company raised money, and this respective stock tracks the performance of VMware, whereas Dell benefited from raising those funds in order to fund the management buyout and also be really rewarded for the performance of this data analytics division in the company, right? Now, if you were to buy this, you don't own Dell at all. You don't own any of their assets. You're just tracking the performance of the subsidiary. And so that's why there's not a lot of market demand anymore, and that's why there's not a lot of tracking stocks. I was pretty surprised when Dell issued this initial tracking stock, but that means that even now and then there are some investors that want to hold this. Really, investors, the reason why the valuation of a tracking stock changes is simply based on the performance of that subsidiary and the expectations of future outperformance. Okay, so that's the big thing. Now, Another one is master limited partnerships, MLPs. And these are really cool. I kind of like them. So MLPs are limited partnerships in which the shares are publicly traded. A limited partnership consists of a general partner, a GP, and one or more limited partners, LPs. The general partner runs the business and bears unlimited liability, whereas a limited partner has no ownership interest in the assets that are put in the master limited partnership. Corporations have used MLPs to redistribute assets so that their returns are not subject to double taxation. In a rollout MLP, corporations may transfer assets or divisions in separate MLPs. So essentially the benefit with an MLP is that when consider just a simple company listed on a public exchange. If they were to sell a respective division and those cash proceeds, they would pay a capital gains tax at the corporate level for the company to bring in the after-tax cash returns. And if that corporation wanted to pay out the remaining after-tax returns to shareholders through a special dividend, shareholders will also be taxed at their marginal tax rate once they receive that dividend. So that's double taxation when you're really talking about selling a certain subsidiary. With a master limited partnership, what the company can do is it sets up this MLP, it redistributes, it reassigns these assets, the assets that it wants to sell, to this respective MLP. The shareholders receive shares similar to in a spinoff. They receive new shares in this new MLP, in this new entity. They do not own the respective assets in that MLP. And the corporation can do whatever it wants. It can pay out a dividend or it can sell those assets and use the MLP to then distribute that special dividend. But when it does, it's a flow-through entity rather than a corporation. So the MLP at the corporate level, they won't pay taxes anymore. So if they sell the business, those cash proceeds are distributed as a special dividend, and only the investors are the one who pay a tax at their marginal tax rate. And so that saves a lot on tax. These are very popular back in the day. Once again, there's a lot of rules that have changed, and so the popularity of these MLPs has declined. Now, the key advantage of the MLP is the elimination of the corporate layer of taxation. Stockholders in a corporation are taxed twice on their investments, first at the corporate level and then as distributions in the form of dividends at the individual level. Master limited partnerships are not taxed as a separate business entity, and the returns to the business flow through to the owners just as they do in other partnerships. So now we've talked about the key restructuring options available for a public company in North America. The divestiture, which is selling the business, is selling the entity to a third party. The equity carve-out, which is retaining maybe 20-30% of the subsidiary, retaining a 30% interest in that business, but selling the remaining percentage to a third party, an outside bidder, and therefore raising funds. A spin-off is just separating that, spinning off that asset into a separate legal entity and awarding the shares in that new business to existing shareholders. No funds are transferred, but rather you're splitting up the company to really create focus and, increase transparency for the assets so that investors can value the assets correctly. Split ups or bust ups or liquidation, you just sell everything and pay a special dividend and get rid of the company. MLPs are flow-through entities, so investors only pay at their marginal tax rate and do not pay the corporate tax layer. And tracking stocks are these public units that track the underlying performance of a respective division. The company still owns that division, but the performance of that division affects the valuation of those respective units. Those are the available corporate restructuring options for companies. Other than that, as always, if you did enjoy this video, please like and subscribe to the channel for more. If you have any questions, please do comment below and I'll be sure to get back to you as soon as possible. Have a great day, guys. Thanks.